I just hope you arrive on YouTube. And as usual, it's 8:50 p.m. East African time. That's Kenyan time. So, as a live stream dedicated, I'm supposed to discuss a part of Peter Lynch's book that is Beating the Street, and it's kind of 1 hour live stream. That's what I'm going to specifically focus on. So, um, if you're one of those individuals who is going to be frustrated if I kind of not have a clear flow, then I may request you to stay around because I'm going to just mumble a lot, but I'm going to do my best in order to avoid moving from one subject to another. But as usual, we have a room for growth, so I'm going to just navigate this as much as I can to ensure that my main objective which I have today, I'm going to achieve them. So the objectives which I have today is to ensure that by the end of this live stream, you're in a position to understand why you should start investing in the stock market. And as we all know, Peter Lynch is one of the greatest investors who has ever run some big companies in the United States of America. So it's a nice opportunity for us to learn one or two things from how he dealt with various subjects on the investing in the stock market and on how he actually came up with the idea of investing in small companies in order to realize huge profiting margins. So Peter Lynch did extremely well, but as usual, every individual, every investor has some setbacks, and we are going to learn from some of the setbacks which he experienced. At the same time, we are going to understand on how he navigated various situations in the stock market. Number one, we need to understand why he decided to quit the stock market. So only a few individuals have the luxury to say no to a fat paycheck. That's all we should realize. There are most individuals who can't say no to earn salary because if they have been awarded that opportunity to say no to any given salary, it must be that they are in a good financial position. But most individuals don't have that luxury to say no to any given amount of money because in one way or another they fully depend on that salary for them to be successful or for them to get there for their daily livelihoods. So for Peter Lynch in around 1992, he had that capability, that luxury to say no to the fat paycheck which he was being awarded at the farm which he used to work. So he decided to quit his management of the portfolio which he had managed for around 13 years because he was no longer had the opportunity to see his kids grow, and that's why he decided to quit his own job. So why does Peter Lynch say that individuals should start investing in the stock market? Because money in stocks over a long period of time is more profitable than money invested in CDs, money market funds or bonds. Overall, money invested in the stock market gives investors a higher return compared to money which has been invested in the cash deposits, money market funds, or bonds. So if you are an individual who wants huge rewards, then Peter Lynch directs you or advises you to go and start investing in the stock market because overall, in the long period of time, rewards which are experienced in the stock market are so huge compared to rewards which are invested in the CDs, which are invested in bonds, which are invested in money market funds. So Peter Lynch encourages individuals to invest in stocks. Also, he goes ahead and says, hence, if you expect to create more money than you have today, invest a chunk of your money in the stock market. That's the advice which he gives individuals. So if you expect to have huge amount of money, then the best advice which you can get from beating the beating the street that's a book by Peter Lynch, is that you should invest a chunk of your money in the stock market. So despite the fact that stocks in general has better returns, individuals continue to invest in deposits. Individuals continue to invest in money market funds. So money market funds in general, they don't have huge risks compared to stocks. And most individuals who don't have the stomach to see their money or their portfolio reduced into a half, these are the individuals who end up investing in the stock, not in the stock market. These are the individuals who end up investing in bonds, who end up investing in cash deposits, who end up investing in money market fund. So because they are so scared that they may lose their resources, that's why they end up missing the rewards which the stock market enable individuals to have. So to succeed in the stock market, that's another advice which we can get from Peter Lynch's book. To succeed in the stock market, you need to have a stomach. So for most individuals, if you cannot withstand the idea that your money may reduce into a half, then you should not be investing in the stock market. Because in the stock market, in one way or another, there are ups and downs in the stock market. So if you don't have the stomach of investing, of seeing your resources, of seeing your hard-earned money reduce into a half, then you should not invest in the stock market. So it's not the brains which can enable you to succeed in the stock market, but it is your stomach as the gut which ensures that you are healthy, you have a sound mind. That's true for the resources which you're going to invest in the stock market. You need to ensure that you have the stomach to watch your portfolio reduce into a half, and you should not lose patience once you see your resources reduce into a half. You need to have the patience, you need to ignore the market, you need to ignore individuals who are declaring that the world will come into an end. So to be successful in the stock market, you need to ensure that you have strong principles and you don't get frustrated once the market decides to go against you, against your wishes. So that's also what we have understand. So to succeed in the stock market, investing, you need to ignore the noise. That's another thing which you need to consider if you're interested to invest in the stock market. You need to understand it is not the head but the stomach which will determine if you will succeed in the stock market or not. So those are the things which you need to take into consideration. To succeed in the stock market, it's not how intelligent you are, but how strong you are to watch your portfolio reduce, and also to watch your portfolio having different reaction to different circumstances. So that's it. Always buy what you know. So that's one of the best advices by Peter Lynch. So there are individuals who get excited to buy stocks of different companies which they don't know even how they work. So for instance, I'm going to use a few companies from the Kenyan context. So for instance, I'm one of those individuals who has I've not invested in the stock market for a long period of time, but I do understand that if I had that opportunity to start the investing area, probably I would have been crushed so badly because I may have ended up doing much of the gambling instead of at least doing some research, basic research on given companies. So let me give you an example. On my portfolio, I may end up mentioning some companies which I have in the Nairobi Stock Exchange. I've invested in what I've invested in Cooperative Bank. I've also invested in Safaricom Safaricom, not a Safaricom Bank. I've invested in Safaricom. I bought some CIC insurance stocks. I've also bought some HF Group stocks. I've also bought some KPLC stocks. I've also bought Kengen stocks. So among those companies, one of the companies which did amazing was the KPLC stock. It was pure luck. It was gambling. I didn't knew how the stock market was being researched, but I was lucky to have some good returns on KPLC and also have some good returns on Safaricom. I've been having good returns on Kengen. Probably in 2025, most individuals have made money in the stock market. But I lost some money also in by investing in East African cables because I didn't understand. Yeah, I probably understood on the role which East African cables plays. That is the role of supplying electric cables, electric appliances, some materials which are used in the construction industry. But I didn't understand the fundamentals of East African cables. It was in huge debt. It was having a lot of issues in Tanzania and much more issues. So if I could have understood on the basics of this company, then I may not have lost some money in the stock market. But as Peter Lynch has said, losing money in the stock market is one of the things which you need to make peace with. At the end of the day, you are likely going to lose money in the stock market, but one of the mistakes which you may make is to continue losing money once you understand that this is not a right investment. If you continue making that huge mistake, then that is what is the worst mistake which you could have committed. But losing money in the stock market is kind of a common scenario. But the mistake is if you continue investing in that company which you are losing money. So you need to understand what you are investing in, understand the basics of the company which you are interested to invest in. Never invest blindly. We need to move to the next one. Diversify to reduce risk. So most individuals may be so sure on what is going to happen to any given company, and they may end up blindly investing a huge chunk of their resources in that company. But to reduce that risk, you need to diversify. And one of the things which Peter Lynch says is that you should at least invest in 5 companies. Choose 5 companies, do a lot of research on those companies, understand what those companies are doing, and invest in those companies. Never trust your resources into an investment of one company. You may end up regretting that position. So you should always ensure that your investment in the stock market is always diversified. Never invest 100% of your resources in any given company. Always spread risk by investing in different sectors, in different companies. Also, investment should be done in a regular time frame to reduce temptation of guesswork. So there are those individuals who may end up thinking that they will time the market. But as individuals who have done it over a long period of time, I've said timing the market is one of the riskiest strategy you may end up using in order to beat the market. There are individuals who may tend to believe that they are in the position to beat a market. But at the end of the day, markets always react in a given manner which most individuals never understand on how. So to mitigate the situation of reducing the risks on timing the market, Peter Lynch encourages individuals to always invest on a regular basis on a regular time frame. This will always reduce the risk of trying to time the market, which may end up so badly. So for the individuals who want to be successful in the investment in the stock market, ensure you invest on a regular basis in order for you to reduce the whole situation of trying to time the market, because timing the market is one of those strategies which is a losing strategy. So for those individuals who are joining the live stream, you may end up liking this live stream if you get interested or you have gained some 1 or 2 things from this live stream. I encourage you to like the live stream, and also if you are interested, you may share with those individuals who you may think that they may gain 1 or 2 things from this live stream. I appreciate for you taking much of your time, because there are some things which you could have done or which you could have used this time which you are taking to watch. And probably for you deciding to watch this live stream, it's a much appreciated opportunity which you have granted me. So I'm going to try my best at least to reduce my mumbling and enable you to gain 2 or 3 things from this live stream. So like this video, and also you may post your comments. I may end up reading those comments. So yo, no one is what there. Yeah, no one is there, and as usual, it's kind of the So I can't complain that no one is there. Just they start and I've not been consistent over a long period of time. So I need to blame myself. So appreciate AF Maman. That pronouncing that name is so difficult, but I'm trying it. So I appreciate AF Maman. So appreciate for those individuals who are joining the live stream. So we should continue. So your portfolio should not be less than 5 companies. So that's what Peter Lynch encourages. So for instance, if you are in Kenya, so you should have different companies. For instance, this is not a financial advice, but I'm encouraging individuals. I'm kind of using these examples in order to enable individuals to have an idea of what Peter Lynch is talking about. For instance, we have telecommunication. We have only one company in Kenya which deals with that, and that is Safaricom. So seeing Safaricom on how it's progressing in going into it, actually in Kenya, it's one of the best companies in telecommunication. Yeah, Airtel is there. There are challenges which are associated with Safaricom. The competitiveness of Airtel is not that strong. They are not challenging Safaricom that seriously. So Safaricom is an amazing telecommunication company in Kenya, and also we have seen on how they are doing in Ethiopia. They are doing an amazing job. So you can choose Safaricom from the telecommunication. Then we can go to the banking industry in general. The banking industry in Kenya is doing an amazing job. So you can pick, let's say, for instance, you can choose the Kenya Commercial Bank, we have the Cooperative Bank, we have APSA, we have NCPA, we have Diamond Trust Bank. So those are the companies which are listed. For my own. I decided to choose Cooperative Bank because the main reason why I decided to choose Cooperative Bank, their PE ratio was kind of amazing. KCB, not KBC. KCB, their PE ratio, even if they have gone to other African countries, it was that big. So I decided not to choose KCB. And also, there's some idea which is also I'm going to go next, where Peter Lynch talks about the buildings, the structures which have been put in place by different organizations and how they reflect how companies spend their own resources and money. So you can decide to choose one company from the banking sector. So we have at least 2 companies, that is Safaricom and, let's say, Cooperative Bank. And another one you can choose from the energy sector. We have the likes of Total, KenGen, and KPLC. You may decide to go with KenGen or KPLC. That's our 3 companies. We also have some what's another sector which I've chosen from. So we have the, I can say, agricultural sector. We have the Kapchora tea. We have Williamson tea. We have Sasin tea. I decided to go with not Kapchora, but I decided to go with Williamson tea because I saw their PE ratio was amazing. It was really encouraging, even though it's a bit expensive. Sasin, it's kind of they are they are doing amazing, but they have some issues. It's not a financial advice. It's kind of just my opinion. And we have Captura tea. It's also doing amazing, but I thought their PE ratio was over the rooftop. So, and also I thought I can't afford 100, 400 per share, whatever. So I decided to ignore Captura tea and go for Williamson tea. So those are 4 companies. And what's another company which I've also tried to invest in? We have the insurance sector. So I was supposed to talk about the insurance sector. So the insurance sector, I kind of did my high school and I did some business, but the insurance sector or the insurance subject was one of those issues in the business subject which I was not understanding on how they go about those all issues. I kind of have some lame idea that the insurance sector they make money by at least some individuals not going for their claims, and also for them deciding to not even benefit or reward those individuals who have been, let's say, if your car faces some accidents or gets into an accident, some insurance sector may decide not to reward you. So that's how the insurance industry generally gets their revenue. So I decided to invest in the CIC insurance, even if their BE ratio is over the rooftop, but I saw that their revenue was increasing over a long period of time, and they have been giving out the dividend, even if they have not been increasing, but they have been giving out dividend over a long period of time. So those are around 5 companies which you can invest in Nairobi Stock Exchange. As I've said, that's not a financial advice. It's kind of my own opinion on trying to explain on how we should be investing by diversifying. So to diversify, you need to invest in different sectors and you need to have an opinion on how those companies are doing. So young people, more especially young people, should be investing in stocks. Stocks on average have been returning 11%. So why does Peter Lynch decide to encourage young individuals to start investing in the stock market? It's because you as a young individual, you need to realize that stocks have a good return. On average, they have been returning 11% per annum. That's on average. There are sometimes it may return 7%, there is sometimes it may return 20%, there is sometimes it may return 5%, there is sometimes it may return around 30%. But on average, over a long period of time, stocks are proved to be returning an 11% per annum. So for young individuals who are young, you are supposed to ensure that you invest a huge chunk of your resources in the stock market. Why invest in the stock market? Because you are assured that your rewards will be much big compared to investing in the stock, in the money market fund, in the bonds, in the certificates of deposit. And you also have time to recover. If you, let's say, your resources get wiped, you can recover. It's not compared to an individual who is 60 years old. If you are young, you are in your 30s, you are in your 40s, maybe 20s, 15, you can start investing in the stock market because you have a long time to ensure that if things go south, you can recover your resources. So for those individuals who want to multiply their wealth, who want to increase their resources, that's why Peter Lynch says you should invest in stocks. Don't go for bonds, don't go for certificates of deposit, don't go for money market fund. That should be left for individuals who are above 60 years old, who their risk tolerance is not that top notch, who if their resources get wiped into a half, they may end up collapsing and dying. So for those young individuals who are below, let's say that 5, you should ensure that a huge chunk of your resources are invested in the stock market. Don't go for CDs, don't go for money market funds, don't go for bonds. So it's not, this is not laws which I'm discussing here. I'm just giving out what Peter Lynch tries to say. And as usual, I tend to agree with those individuals who have at least made huge returns on the funds which they used to read. So another issue which we need to focus on is once you are trying to figure out on how the given corporate tries to manage its resources, you need to figure out on how they have build their, let's say, structures, on how they spend money and resources on buildings, on how they spend money and resources on avenues, offices. Those things you need to take into consideration, because if you are going to invest in that company, you need to be assured that you are going to fund the lifestyles and also the the situation in which those individuals who are working in that company are in. So that's why Peter Lynch goes ahead and says corporate extravagance is directly proportional to management reluctance to reward shareholders. So some individuals may decide to have extravagance in their offices, and this takes away from shareholders. If these individuals are going to reduce their costs and the extravagance which they exhibit in these offices, the extra resources are going to go to shareholders. So once you go to any given company which you are interested to invest in, and you understand that they are spending huge resources in maybe constructing dining rooms, in hiring extravagant cars, in spending on luxury meetings, then you need to understand that that's your money which is going to be used in order to fund those projects, in order to fund those expensive cars which the executives will be driving in. So you need to understand that the money, the lifestyle, or the kind of the experience which individuals, workers who are working for any given company are being treated with, those that will be your resources, that will be your money which will be used to fund those experiences. Focus on companies and not the stocks. So sometimes you may end up finding that a company has, let's say, low, it has a high value, its stocks is so expensive, but the basics, that is the financial statement, the balance sheet, is actually so awkward. For instance, the equity debt to equity ratio is not something which is promising. So you need to focus on those things, the basics. For instance, on the, if the revenue has been growing over a long period of time, if this company has been rewarding its shareholders with continuous dividend, and also which has been growing over a long period of time, if this company is reducing its debt, if this company is buying back shares which it has given out to the public, that's the only way which you are going to ensure how healthy a company which you are interested to invest in is doing. Never get so caught up in the price of any given stock that you end up ignoring the basics of a company. So you need to understand that those are the things which you need to take into consideration. Another thing you need to seriously focus on is buy companies with a strong balance sheet and also with favorable prospects. So let's say you are going to buy a given company, and this company has a poor balance sheet, and the future of this company is so, how can I say, it doesn't have a future. There's no need to invest in that company. You don't have to be the individual who is coming to save that company. You better allow it to collapse, because you as an individual, you are interested in making money and not saving a company. So if you are going to save any company, then you need to be assured that at the end of the day, that company is going to emerge as successful and get your money back, and also have some extra money from that investment. So the whole idea of just buying a given stock because you want to save that stock, that should be done probably by richest people who are interested to save companies which are actually disappearing. For you as an investor, for you as a person who is interested in investment, your main objective should be, how can I make money? That should be your own objective. The whole issue of rescuing a company should also not be your role. If you decide to play that role, it should be because you, at the end of the day, you want to make some money. Hanging out in the mall is the best way to understand any given company than having an advice from stockbrokers. So I want to use kind of my own example. I kind of travel a lot, and I've observed over a long period, or over some areas where I travel to, there is a lot of KPLC individuals who are working, either they are installing new electric lines, either they are doing some services on the electric lines. So the KPLC company, I have seen it, there is a lot of improvement which are taking place. So this is much more important than I being given the advice by a stockbroker. A stockbroker may not be aware on what's going outside there in the field. That's why Peter Lynch tries to say that for those individuals who are, let's say you have been in the supermarket, in the malls, whatever, where the real risk individuals are buying the products of the companies which you're interested to invest in. That would be of much more benefit instead of you receiving some advice from a stockbroker who doesn't understand what's going outside there in the real world. So for you as an individual who is interested to invest in any given company, and you do understand what the role of this company is doing, whether it's providing services, whether you are interested in their own products, whether your friends are interested in their own products. So that would be the best strategy for you to understand that it's a good choice to invest or not to invest in that given company. If you find that you are interested in their products, if you find that your friends are so interested in buying products of a company which you are trying to invest in, then that could be a good gesture which will tell you that you should go ahead and invest in that company. But if your friends have been ignoring the products of that company, they are not interested, the kids are not interested in buying products of that company, then as usual, that could be also a good indicator that probably there are other individuals who have also seen the product of that company, but they are not interested to buy that company anymore. So it could be a nice idea not to invest in that company. That could not be exhibited by those individuals who are seated in offices and they have no idea what's going on in the real world. So you as an individual who doesn't have much hectic work to either go through piles and piles of companies, you should take that advantage because there are individuals who are back in offices who do have no idea on what the really action which is taking place in the outside world concerning the company which you are interested in. So you should focus on that. On the other issue I mentioned about the extravagancy of any given company, there is a quote here I extracted from Peter Lynch's book. The fact that a company you put your money in as a big building doesn't mean that people in there are smart, but it does mean that you have helped pay for the building. That was a quote by William Donald Dan Guy, whatever. It's so hard to pronounce that name. So the extravagancy of any given company which its managers are exhibiting, know that you are funding that lifestyle. So on a balance sheet, so this is also on a balance sheet. On a balance sheet, the shareholders' equity should be twice as much as debt. So there are companies, I need to use one example. So I may be wrong because I'm trying to learn out or the whole issue of the stock market, but there's this company which I tried to go through its balance sheet and I thought it was so pathetic. Maybe I should not go ahead and mention it, but I have seen it's kind of doing well. But no, I just need to mention that company. It's Home Africa. So I kind of try to observe the balance sheet of that company from my own perspective. The moment I gained some few amounts of coins from that investment which I done in Home Africa, I decided to quit immediately because even if they are doing so well in a few like 2 years by now they have been doing so well, but their balance sheet is not encouraging. So I decided to quit because I didn't want to face the same experience which I faced with the East African cables, where I didn't have an idea on how East African cables were doing their business, and they ended up being suspended from the Nairobi Stock Exchange. Now I'm in a position where I can't get my money out of the Nairobi, not the Nairobi, but East African cables because I can't buy, I can't sell. So it's so discouraging, but it was a nice experience to learn by investing a few coins in that stock. So I do believe we are almost coming to an end of this live stream. When this industry gets popular, nobody makes money anymore. There is a good example where I asked an individual whether the matatu business is some good investment a person can do. And that driver was somehow honest to me because he said nowadays investing in the matatu business is not a good strategy. It's better you invest in rental property. But as those individuals who watch the whole issue of Ndindi Nyoro, you also add that investing in the rental property is not also a good investment. At the end of the day, there are individuals who make money in those sectors which are kind of scary, whether it's in rental property, whether it's in matatu business. But we need to realize that once any given sector becomes so popular, you are not going to make any money. If every individual is going to invest in that sector because it has been celebrated as creating a lot of revenue, then you need to be assured that you are among those individuals who is not going to make any money in that sector. So if you are that individual who has seen the sector has become so popular, don't just go ahead and invest in that sector, because at the end of the day, you are not going to make money, and we are here in order to make some resources to increase our money. Don't invest in a sector which has become so popular, whether it's a matatu business, whether it is in the rental property, whether it's in the construction sector, whether it's in the border business. Don't invest in those stocks, in those sectors which have become so popular. You will end up losing your hard earned money, or maybe the growth of that hard earned money would be so slow that inflation will always be beat your investment. So here we are in this place to ensure that we beat inflation. At the same time, we get our money grow, and we are not supposed to watch our money just kind of sit there without gaining some interest. So that's the part which I believe I should stop there. But the smallest, so I need to add on something which I'm almost forgot. So Peter Lynch tries to say that we should always limit the amount of stocks which we invest in. Once you get interested in every stock, you may end up not actually realizing or keeping up with how that company is learning, with the progress of that company. So you should ensure at least you have a given amount of stocks. Don't buy every stock. Manage your portfolio. At least have some companies which are capable to tracking their progress, such that you can realize if a company is doing well, you can decide to buy that company. And also if the company is doing not that extremely well, you can decide to sell that company. Also, Peter Lynch tries to say that the importance of diversification. For instance, if you have around 5 companies, one company may do extremely well, another company may be so pathetic, and these 3 companies which have remained may be just be so fine. So you need to ensure that you have at least, let's say, 5 companies, and you may end up having at least 5 companies, 15 companies maximum, and these companies you will be in a position to track them. There's this individual who is known as Chris Oni. I believe I pronounced that name appropriately. He invests in around 7 to 15 stocks. They doesn't do a lot of buying. They are so concentrated in a few companies, which they end up compounding a huge amount of returns on their investment. So there's no need of buying extremely a lot of shares from different companies. You should limit your number of companies and don't exceed any given number which you are able to track. So my name has been Monsieur Magasin. For those individuals who have taken their time to kind of not to kind of to watch this live stream, I really appreciate. And also, if you have got 1 or 2 ideas from this live stream, I encourage you to like this live stream. You can also share, kind of pinpoint your ideas, what you could like I to discuss in my next live stream. See you in my next one.